Good evening, everyone. I'm CA Deepika Agrawal, moderator of this webinar. We are delighted to welcome you all for the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be the moderator for the webinar on detention, seizure and confiscation under GST and fundamentals of ESOPs. In short while, we will start this webinar. First, I would like to apprise you about the CP committee. The CP committee consists of the chairman CA Satish Kumar Guji Gupta and vice chairperson CA Vishnu Goyal. The role of a chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. The future of CA profession depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. Committee believes that members of ICAI should look beyond the traditional areas of practice and seek new areas of business and profession. Hence, the CP committee is mentoring the members by providing guidance through various workshops, seminars, national conferences, background material, etc., and simultaneously by encouraging young and dynamic professionals to grow as speakers and masters of ceremonies in CP programs. The program for this evening is as follows. We have 2 sessions of 1 hour each, and topics are detention, seizure, and confiscation under GST, understanding practical insights on Section 129 and 130 of CGST Act 2017. And the second session will be on fundamentals of ESOPs. Our eminent speakers will talk about the above 2 mentioned emerging areas of professional interest. Now, as the chairman and the vice chairman will be joining us after a moment, I would request our speaker for the evening, CA Karan Mittal, to please take ahead the program. Before he takes ahead, I would like to give a brief introduction of CA Karan Mittal. He is a dignitary who has 3 years of experience specializing in GST litigation, assessments, appeals, compliances, and drafting. With a strong commitment to professional excellence, he actively represents clients in complex GST disputes and show cause notice appeals. His expertise and dedication to knowledge sharing make him a valuable speaker, and we are looking forward to CA Karan Mittal to share his valuable experiences to all our members in the CP Continuing Professional Education. Can I hand over the mic to CA Karan Mittal now?
Hello. Hello, good evening, everyone. Here, thank you. First of all, I would like to thank you all for joining this session and conducted by CP committee. Thank you for having me here and giving me this opportunity. Let's begin with the session. Today we are here to discuss inspection, detention, release and confiscation of goods and conveyance under GST. We will have to go through the flow of various events in order to have a deep understanding the how, why and when inspection of goods. Hello.
CA Karan, you are on mute. Can you please unmute?
Okay. We will have to go through the flow of various events in order to have a deep understanding of how, why, and when the inspection, detention, and confiscation of goods and conveyance happen under GST. Let's begin. Section 68, inspection of goods in movement. Section 68 targets movement. Proper officer will inspect goods or conveyance which is in transit. This heading is very clear that inspection is undertaken in respect of goods or conveyance which should be in movement. Section 68 talks about 4 points. First, that person in charge shall carry such documents. Second, which shall be validated by proper officer in such a manner. Third, as per section, person in charge is also required to produce said documents. And fourth, allow inspection of goods and conveyance by proper officer. In section 68, it talks about four things: that person shall carry such documents, and such documents shall be validated by proper officer in such a manner, and person in charge to produce such document and also allow the proper officer to inspect his goods and conveyance. Now, what are these documents? This is covered under Rule 138A. Rule 138A, documents and devices to be carried by person in charge of a conveyance. Rule 138A requires person in charge of a conveyance to carry with him invoice or bill of supply and copy of e-way bill. Now, question is whether the e-way bill is physical or electronic form. Person in charge is required to carry copy of e-way bill, whether it is in physical form or electronic form, or whether e-way bill detailed map to RFID attached to conveyance. It does not make any difference. Either an e-way bill number available in the printout form or SMS, or it may be written on an invoice. All these forms of e-way bill are valid. Now let's talk about what is RFID. RFID is a radio frequency identification device. Uses radio waves to detect, identify objects. A transporter would be required to obtain an RFID tag embedded at a pre-specified location, that is basically on the windscreen of a vehicle. The details of e-way bill generated for goods being carried by the vehicle would be fed into this device. The details fed into this device and uploaded same on the government portal. Currently, this RFID has been initiated by firstly by Uttar Pradesh. Other governments has not made the mandatory of it. Rule 138. Now, when was toll and e-way bill is integrated? Under GST, e-way bill system was integrated with the FASTag toll data. Firstly, it is proposed and signed in 2019, but it comes effectively from 1st Jan 2021. RFID and FASTag readers e-way bill was that when the vehicle transported from the toll plaza, it crosses the toll plaza, the data has been automatically fetched to the government officials. This information later used by revenue officials to validate the supplies made by the GST registered person. It is also seen that sometimes department prepares SCN on the basis of the data received from toll plaza. In such case, taxpayer should verify the period under consideration. If the period covered under before 1st January 21, then in such case, the taxpayer should raise this point that the toll and e-way bill integration started from 1st January 2021 to substantiate his facts. Moving forward, as per the Rule 138A, person in charge is required to carry copy of invoice or e-way bill, right? But there is just one case where person in charge or would not require to carry physical copy of invoice. That is when e-invoice is available with the QR code. In such case, person in charge is not required to carry physical copy of invoice. Now, when a vehicle is intercepted, then as per Rule 138B, verification of documents and conveyance. When vehicle is intercepted, the proper officer as per Rule 138B has a power to verify and validate the e-way bill for both the inter and intrastate movements. What does proper officer verify? The proper officer shall verify validity of e-way bill, whether cancelled or not or expired. Proper officer shall verify e-way bill particulars versus document carried, such as tax invoice, bill of supply, delivery challan, transporter's ID, vehicle number in Part B, document number, date, consigner, consignee details, GST number of consignor, consignee, HSN description, quantity, value, distance, pin to pin, route consistency, and transshipment updates, or consolidated e-way bill if used. So, in short, Rule 138A lists the documents to be carried, and 138B is the verification power to verify such documents. intercept a conveyance and verify e-way bill. There is an exception that is if there is a specific information for evasion, physical verification of specific conveyance may be carried out by an officer after obtaining the required approval. So verification is not by any officer as per a rule. It is authorized by a proper officer except in case where the specific intelligence scenario with prior approval. The term proper officer is defined under section 2 subsection 91 of CGST Act 2017. And also there is a circular that is 3/3 2017 of CGST as amended from time to time, lays down the function of proper officer under various CGST provisions. This circular is what that the department relies to authorize specific officer for interception and verification under Rule 138B. So therefore, verification under Rule 138B must be by proper officer authorized under Circular 3/3 2017. Now, where the person in charge of a conveyance fails to produce any prescribed document, where the documents asked in the Rule 138A, these documents are not provided by the person in charge, or where the proper officer intends to take under inspection of goods and conveyance, then he shall record a statement of a person in charge of a conveyance in form MOV 01. In addition, where the proper officer shall issue an order of physical verification or inspection of a conveyance goods and documents in form GST MOV 02, requiring the person in charge of a conveyance to station the conveyance at a place mentioned in the order and allow this inspection of goods. Rule 138C, inspection and verification of goods. The proper officer shall within 24 hours of inspection prepare a summary report in Part A of Form GST EW03 and upload the same on the common portal. Within the period of 3 days from the date of issue of order in Form GST MOV 02, order for physical verification, the proper officer shall conclude the proceedings of the inspection proceedings either by himself or through by a proper officer authorized in this behalf. In case the circumstances are such that he is unable to conclude inspection within 3 days, the proper officer can apply for extension, for which he is required to take a written permission in Form GST MOV 03 from the commissioner or any authorized by him. Extension of time beyond 3 days and a copy of order of extension shall be served on a person in charge of the conveyance. Therefore, maximum time limit for concluding physical verification is 3 + 3 days. There is an exception under Rule 138C that is states that the period of 24 hours or 3 days shall be counted from the midnight of the date on which vehicle was intercepted. So this is important that a person in charge is aware of his right and the time limit where which the proper officer has to conclude his inspection. Now, on completion of physical verification or inspection of a conveyance and the goods in movement, the proper officer shall prepare a report that is final report. Such physical verification in Form GST MOV 04 and serve a copy of the said report of a person in charge of the goods and conveyance. The proper officer shall also record on the common portal the final report of the inspection in Part B of Form GST EWB 03 and within 3 days of such physical verification or inspection. As per Rule 138C, it is important to note that once the good is in conveyance and have been physically verified in a state, they should not be re-inspected anywhere as unless there is a specific intelligence of tax evasion. So if there is a specific intelligence that vehicle has been, then the vehicle has been intercepted. Otherwise, if vehicle is already detained by one state, then the same is not intercepted by another state until unless there is a specific intel. So now if they, in case of no discrepancies found post verification, if the proper officer has made the verification of a vehicle, then if no discrepancies has been found, then the goods and conveyance, the proper officer shall issue a release order in form GST MOV 05 and allow the conveyance to move further. So now what happened if in this case, if discrepancies has been found by the proper officer when the vehicle has been intercepted? In case vehicle has been intercepted by the proper officer and there is some discrepancies has been found, then proper officer shall impose the liability under section 129. When it is opinion, when the proper officer is in opinion that the goods and conveyance need to be detained under section 129 of CGST Act, or if any person is transporting or storing goods in transit in contravention of provisions of the Act, rules, or such goods, conveyance, and documents are liable to detain or seize, and the proper officer shall issue an order of detention in form GST percent of value or 25,000, whichever is less. In case where owner does not come forward, then release on payment of higher of penalty, that is 50% of value or 200% of tax payable. The owner does not come in a case where are tobacco products. In tobacco products, usually owner does not come forward. Or in case of exempted goods, 5% of value or 25,000, whichever is less. Usually the penalty is made through cash ledger. So after the amount of penalty has been paid in accordance with the provisions of this act, the proper officer released the goods and conveyance in order by releasing the GST MOV 05. Now, in case the owner does not want to pay the penalty in cash, he shall furnish security instead as per section 129(1) clause C, where the owner of goods or proper person authorized by him or any person other than the owner of goods come forward to get the goods and conveyance released by furnishing a security under section 129(1) clause C of CGST Act. The goods and conveyance shall be released by a order in form GST MOV 05 after obtaining a bond in form GST MOV 08 along with the security in the form of bank guarantee equals to amount payable under section 129(1) clause A or clause B. So this was awaited by the Honorable Allahabad High Court in case of Caminova India Limited. However, this practice is not quite visible practically. So generally the taxpayer wants to release their goods and conveyance quickly because of the prior sale commitment. And therefore they choose cash mode. This mode of obtaining a bond and approaching the bank for bank guarantee is comparatively time-taking activity and accordingly less practically less visible. Now moving on, if penalty levied under the order issued under section 129 is not paid within the 15 days. Now what happened if the penalty is not paid within the 15 days? In such case, the levied penalty is not paid within the 15 days from the date of receipt of order, copy of order passed under section 129 subsection 3. The conveyance and goods so detained or seized are liable to disposed in a manner and a time as specified under Rule 154, which talks about disposal of proceeds of sale of goods or conveyance and movable or immovable property, and Rule 144A, which is talks about recovery of penalty by sale of goods or conveyance detained or seized in transit. After receipt of goods under section 129 in form MOV 09 and during the period of 15 days before the payment of penalty, the taxpayer can file an appeal against the order of penalty levied by him. So in the case where the during the period 15 days before the payment of penalty. Now previously the pre-deposit of such appeal was 25% of penalty under section 107 of CGST Act. which has been now reduced to 10% via notification. So and it is made effective from 1st October 2025. Before that, it was 25% pre-deposit amount. Now, after 1st October, it comes to 10%. So, in case, note, there is a period of 15 days can be reduced in case of perishable or hazardous good. If there is a fruit or vegetable items or cake or pastry, then it shall be definitely intimated to proper officer that we have a perishable product. There is another important thing is that under proviso to 129, the transporter has given a facility to release the conveyance by paying penalty of rupees 1 lakh, which is less. This is mainly because transporter is losing his business and his vehicle is detained due to no fault of his own. Why should he suffer? So here, the transporter has given the facility by paying the 1 lakh rupees, he can release his detained conveyance. Now comes to some example under section 129 to get a better understanding how the penalty works. When owner comes forward, taxable goods at the rate 18%, value 10 lakh rupees, GST at the rate 18%, that comes to 1,80,000 rupees. When the penalty as per section 129(1) clause A, it comes to 200% of tax, that is 1 lakh, that is 3,60,000. On releasing of penalty payable, that is 3,60,000, not made, then notice comes in 7 days plus order in 7 days. Example 2, owner does not come forward. Like in tobacco cases, owner usually don't come forward. Value 10 lakh rupees, GST at the rate 18%. It comes to 1,80,000. When the penalty is 50% of value or 200% of tax, where it comes to 5 lakh rupees or 3,60,000 rupees, whichever is higher. So it comes to 5 lakh rupees. In example 3, exempted goods, where the owners come forward, value is 15 lakh rupees, 2% of value or 25,000, whichever is less. So it comes to 25,000 rupees. In example 4, where owner does not come forward, 5% of value or 25,000, whichever is less. So it comes to 15,000 rupees. In example 5, release against security bank guarantee. By taking the example 1, where the value of penalty is 3,60,000, furnishing security equals to payable amount. Action, given bank guarantee of 3,60,000 in prescribed form, that is MOV 08. Goods or conveyance released and pending order, hearing must be given in this case. Now, in another example, transporter gets only conveyance released by paying 1 lakh rupees, where the conveyance released on the payment of transporter of penalty under section 129(3) or 1 lakh rupees, whichever is less. So, if the amount of 1 lakh has been paid, in this case, conveyance has been released, but goods remain detained till the payable of penalty. Now, there are some practical scenarios. First, it was seen that proceedings under section 129 were initiated even for a little technical or clerical error, like example error in the address. Therefore, it was clarified via circular number 64/38/2018 of GST. Proceedings under section 129 of the CGST Act may not be initiated in the following cases. And the following cases are spelling mistake in the name of a consignor or consignee, but the GST where is applicable is correct, error in the PIN code, but the address of the consignor and consignee mention is correct. Subject to it to the condition that the error in the PIN code should not have effect of increasing the validity of period of e-waybill. Third, error in the address of the consignee to the extent that the locality and address details of the consignee are correct.
Is there some problem, Mr. Mittal? Our speaker will be joining shortly. I think he has some technical error in his computer. So please cooperate with us for the time being. Yes, Mr. Mittal, you can continue.
Yes. So, a record of such consignments where proceedings under 129 of CGST Act have not been invoked in the view of situations listed above shall be sent by a proper officer to his controlling officer on weekly basis. Another is that can the proper officer detain the goods in contravention of timelines mentioned under Section 129? Can proceedings under Section 129 be initiated or continued even after passing of time limits given in Act? In such delayed applications, proceedings under Section 129 are valid. If after detention, no notice is issued within 7 days of such detention or order is passed within 7 days of the date of service of notice, in such case, Section 129 is considered as abandoned and the goods have to be released. If such notice or order has been issued or passed after the set time limit, that is after 7 days respectively, in such case, notice or order is issued or passed in contravention of timelines given in the Section 129 and accordingly is liable to set aside and the goods will have to be released. In such case, no order can now be issued to detain or confiscation. This is backed by the Honorable Madras High Court in case of Madhesan versus State Tax Officer of Commercial Tax Department in 2024. Another is also a good scenario in case where a statement of a person in charge of or a driver recorded be used to initiate penalty proceedings. This is backed by the Allahabad High Court in case of Ravi Timbers versus Commissioner Commercial Tax UP, where has said that the statement of truck driver recorded by a proper officer cannot be basis for initiating penalty proceedings and no intention to evade tax can be established from the statement of a truck driver. So when the entire documentation is available on the record, so it is a really a good judgment. Another thing is another appeal for refund of penalty paid to release the goods and conveyance. In case where a penalty under Section 129 has been paid under protest to release the goods and conveyance during the time, but the taxpayer or owner was not agreeing with the facts. In such case, the owner can file appeal for refund of penalty paid, but he has to substantiate the facts that all the documentations are there to release the amount. Now, let's have a overview of whole process. Right from inspection of vehicle till the order of detention and payment of penalty under Section 129 through chart. Interception of vehicle, production of relevant documents by person in charge, verification of documents by proper officer. In case no discrepancy, release the vehicle in GST M05. If fails to produce prescribed documents, undertaken inspection. Record the statement of person in charge in GST MOV 01. Issue order for physical verification in GST MOV 02 within 24 hours in Part A GST EWB 03. If conclusion of proceedings not completed within 3 days of inspection, to get written permission for extension in GST MOV 03 and then physical verification report in GST MOV 04 and the final report of inspection in Part B of GST EWB 03 within 3 days of physical verification. Now there are two cases. If the discrepancy is found, if no discrepancy has been found. If no discrepancy has been found, then the release order in GST MOV 05. If discrepancy found, then detention in MOV 06. Penalty not paid. If GST MOV 07, if penalty paid and or bond is given in GST MOV 08, then the release order in GST MOV 05. If penalty is not paid, then objection filed against proposed amount, and then the speaking order in GST MOV 09 by the specifying the quantification. Now we have discussed the whole process from the inspection till detention. Now let us move on to confiscation of goods and conveyance. Section 130, confiscation of goods or conveyance, levy of penalty. This section starts with the word where any person. This means that if any person does anything contained in this section, then liable to get their goods or conveyance confiscated and also liable to penalty under section 122. So, where any person supplies or receive any goods in contravention of any provision of this act or rules made thereunder with intent to evade payment of tax, or here it is important that intent to evade tax, then he shall be liable for confiscation of goods or conveyance, and also such person is liable to a penalty under section 122. Another clause 2. So, where any person does not account for taxable goods liable to pay tax under this act, or that means if any person fails to account goods which are liable to tax, in this it leads to confiscation of goods and conveyance. Or such person is liable to get GST registration. His supplies are liable to tax, but he is supplying taxable goods without applying for GST registration. Then in such case, he is liable to confiscation of such, and also such person is liable to be penalty under section 122. Fourth, where any person contravenes any provisions of this act or rules made thereunder with intent to evade payment of tax, then he is liable to confiscation of goods and conveyance and also liable to penalty under section 122. But this scope is wider than the clause 1. Fifth, where any person uses any conveyance as a mean of transport for carriage of goods in contravention of the provision of this act or rules made thereunder, but owner can avoid confiscation if he can prove that confiscation was without his knowledge. Usually, where the conveyance to carry goods and in goods in contravention of this act or rules, then the leads to confiscation of goods and conveyance under section 129, and also leads to penalty under section 122. But in this case, if owner can prove his convenience or lack of knowledge, then he can avoid this penalty. So this is a good option given to transporter. All the clauses specify 1 to 5. Then in such case, goods or conveyance shall be liable to confiscation and person shall be liable to penalty under section 122. Notice for confiscation of goods or conveyance, levy for penalty in GST form GST MV 010. Now, as per section 130 clause, subsection 2, the section gives the owner of goods an option to pay fine in lieu of confiscation. Fine should not be more than market value of such goods minus tax chargeable, but fine plus penalty should not be less than 100% of tax payable on such goods. If it is a hired conveyance, then owner of the conveyance is given an option to pay fine equals to tax payable on such goods in lieu of confiscation. Here it is given that if the vehicle conveyance is on a higher base, then in section 129, where in the 129 where the transporter has the given option to pay the fine amount to rupees to 1 lakh rupees. But in section 130, if it is not able to prove the convenience, if he is able to prove the convenience that the owner is proves lack of knowledge, then the no penalty as per the clause 5. But if he is not able to prove, then the as per section 130 clause 2 has to pay the tax equal to tax chargeable. So if he is able to prove convenience that does not have any knowledge, then he is avoid the penalty or liability. If he is not able to prove, then he is liable to tax chargeable. Further, if no fine is paid, within 3 months of notice under MOV 010. Then order is for confiscation is passed in MOV 011 for confiscation and demand of penalty. No order for confiscation of goods or conveyance or for imposition of penalty shall be issued without giving the person an opportunity of being heard. Post confiscation, the title, that is ownership, vested with the government. The proper officer can take help of police to take possession of goods. If the proper officer is satisfied that the goods will no longer be required, after giving a time limit of not more than 3 months to pay fine in lieu of confiscation, he may dispose the goods and conveyance and deposit the sale proceeds to the government. Once the sale proceeds has been deposited to the government, then same amount in the form DRC 03 by settled by the government officers. They actually, what happened that in the liability register, the demand will be there. So once the sale proceeds there, and after that the amount get realized from the sale proceeds, the proper officer shall settle down in the amount that standing in the liability register. This case, there are two things. If the amount is surplus from the disposed of, or if there is a surplus, then that surplus amount shall be refunded to that assessee or taxpayer from the proper officer, or if there is a shortfall, then that shortfall is still there in the liability register. A summary of every order in the GST MOV 09 or GST MOV 011 shall be uploaded electronically in GST DRC 07 on the common portal. These are the forms, MOV forms relating to inspection, detention, seizure and confiscation. That MOV 01 statement of owner or person in charge of a vehicle. MOV 02 for physical verification, inspection of goods, conveyance or documents. 3 for extension of time limit. 4 is for physical verification. 5 for release order. 6 for detention. 7 for notice. 8 for bond, and 9, 10, and 11, so on. So these are the forms with their names. Now let's move to some case laws. It was seen that department as a general principle was invoking proceedings under section 130 even without any intention to evade, even when all the documentations are available. Though basically the department is invoking section 130 rather than 129. In 130, there are the higher penalties as compared to 129, and the goods and conveyance both are got confiscated in 130, and in 129 only is a detention. So department sometimes invokes section 130 rather than 129. So there are some cases like in the first case, Honorable Kerala High Court, in the case of Gokul PG versus State of High Court. Here it was mentioned that section 129 are independent provisions. 130 can only be invoked in case of intention of evade of tax. Here, section 130 has been invoked in case IGST has been charged and paid. So no loss to government officials, and no proof was provided by the government that the tax is evaded. So conclusion is that the department appeals. Here it was mentioned that detention proceedings under section 129 cannot be converted into 130. Both are distinct and independent. 129 is to stop transit until the penalty is paid. That is, 129 talks about detention, where 130 is talk about confiscation. That is transfer ownership for contravention of act. So once the detention is invoked, confiscation powers become unavailable. But there is an exception where the penalty is still unpaid despite order issued under section 129. In this, what happened that once the order has been issued in MOV 09 under section 129 and the payment is not made within the 15 days, So before disposal, the confiscation has been made. So in this, the section 130 comes. Otherwise, 129 is separate and 130 is another separate. So 129 and 130 are not related, but there is an exception. In another case law, Honorable Andhra Pradesh High Court, in the case of Messrs. Cluster Enterprises versus Deputy Assistant Commissioner of Andhra Pradesh. In this case, main issue was that proceedings under section 130 be invoked without prior action under section 129. So the conclusion is that 130 can be invoked directly if there is an intention to evade tax, but proper documentation should be maintained. If there is no proper document is maintained, in this case, confiscation order was set aside because the taxpayer asked for documentation based on which SCN or order was issued. And the department fails to prove that same and there was absence of DIN. And thus, this was violating principle of natural justice. So in this case, the order has been set aside on the basis of the documentation that the principle of natural justice has been violated. Another and last case. Honorable Delhi High Court, in case of Kamal Envrotech Private Limited, Messrs. Geon Life Science Limited, versus Commissioner of CGST, Delhi Government. In this case, Section 129 does not override Section 160. Provides that even when the Section 129 contains word notwithstanding anything contained in this act, in the starting in the section of 129, it is specified mentioned that notwithstanding anything contained in this act. So, but it does not override the section 126. So, section 129 deals with the detention of goods and release of detained goods and conveyance by paying penalty, and not just levy of penalty, and therefore cannot supersede section 126 principle of reasonable penalty imposition. Conclusion: High Court said that penalty should not be levied for procedural lapse like mere documentation issues. There has to be some moderation and within which penalty has to be levied. In such case, department petitions disposed of establishing the penalty must be guided by principle of 126 for principle of moderation and reasonableness. So in this case, it is a good judgment where it is specifically that specifically says that section 129, even the word notwithstanding anything contained in this act, but does not override or supersede the section 126, which principle of reasonable penalty imposition. These are all the judgments which are really good judgments and to be considered. This brings us to end of our session. I hope this session help us clearly the how, when, and why detention, release, and confiscation of goods and conveyance under GST. Thank you. Now we can move on to the questions. If anyone has any questions, can ask me related to this section 129 and 130.
Thank you, Karan, for your insightful session on GST. We have certain questions for you from various members who have been part of this session. So, there's a question from Mr. Vikas Saini from Kotputri. He has asked a question: can we release the truck after filling the bond?
Yes. In MOV 08, we can release we can release the goods in the by paying the MOV 08, not the truck, not the conveyance, only goods. It is related for a goods.
Okay. Thank you. All the other relevant questions have been answered by you during your session. So I don't think there's any other question which needs to be asked over here. Thank you so much for your valuable time, Mr. Karan. And we are looking forward for more insightful sessions with you in the future webinars as well. Thank you. Now, as we move forward, we have our next speaker on ESOPs. His name is Mr. Uma Shankar Acharya. He is a distinguished ESOP and equity consultant with over 2 decades of professional experience. He is one of the most experienced ESOP professionals in India, a qualified company secretary and advocate. He has successfully advised more than 450 clients, ranging from Nifty 50 companies to startups, and ESOP structuring equity transactions, regulatory compliances, taxation, and litigation support. He has also practiced law and direct taxes with reputed firms, representing over 200 clients before ITAT, district courts, and the Delhi High Court. We are very delighted to have you over here, Mr. Uma Shankar Acharya. And all our audiences are keen to listen to you on what you want to tell us about the ESOPs. So, moving forward, I hand over the mic to you.
Thank you. Am I audible?
Yes, you are audible.
Yeah. Thank you, Deepika ji. Thank you. My sincere thanks to CP committee as well for inviting me for giving a session on this topic. And this ESOP topic is very close to my heart and mind because I spent near about 2 decades in this profession. ESOP is very vast for me, but may not be appearing so vast for professionals who are not closely practicing or who have not closely seen various aspects of ESOP. So I have got an opportunity to present the fundamentals of ESOPs, wherein I have planned to uh, uh, give some insights into various aspects of ESOPs. Those are quite critical. Let me share the presentation in the meantime. Deepika ji, if you can tell me if my presentation is visible.
It is visible, sir.
Okay, thank you. Before we start the fundamentals of employee stock option plans, I'd like to just tell a few lines about the importance of these ESOPs in India. I'm talking about the modern India, the emerging India that is getting closer to become a kind of, say, developed economy. So three key things. One is the recent change in the employee behavior. So whatever we have seen in last, say, 5 to 7 years, employees are not just relying on the salary or what we in Hindi we call it pagar. So they are more interested. They are looking how the world is changing, how the economy in India is changing, how many millionaires and billionaires are being created out of startups and doing business. So they are more eyeing into getting a kind of a democratic based payment. They are trying to get into a little bit of or a slice of ownership. So that's why they are more interested in getting ESOPs. In any case, statistically, we have seen there are hundreds of millionaires being created in last 5 to 6 years statistically, and most of them got that wealth out of ESOPs only. The second thing is the increased awareness about the equity market, the stock market amongst the Indian youth. So if you see the kind of demat accounts opened prior to Corona and post-Corona as on today, there has been around, say, 4 times growth. So earlier, the total number was around, say, 3 crores demat account. Now, the total number stands at around 13 to 14 crores. So why I'm talking about stock market is that when we talk about ESOPs, we talk about indirectly, we talk about equity as well. So if there is a increased awareness of the equity market, so our people can understand ESOPs so that there shall be better acceptability of ESOPs, which were not there 10 years ago or so. Now, the third thing is the proven enrichment of the corporate economy and the proven enrichment of the individual economy as well through ESOPs. So that has been a matter of business newspapers. So people are much aware of that, and people people are seeing ESOPs with curious eye that what an ESOP is. Everyone is interested now. So it is quite important for us, like a professional, say a chartered accountant, who plays a vital role inside the company and outside the company. Outside means while practicing also. People are looking forward to people are looking forward, looking with expectation. I'm talking about both CA inside and outside. So it is quite important that the aspects of ESOP should also be known by the fraternity. Now coming to the basic understanding of what an employee stock option is. So just a moment. So employee stock option, broadly, you can picturize something that employee stock option and equity has a relation like a body and shadow. So body is the equity and shadow is the employee stock option. So now, as and when the equity grows, or the value of equity grows, the value of equity, I mean, employee stock option also grows. How it works is that, as the name indicates, employee stock option. Option means a choice. Those are generally offered under a plan or granted under a plan. Generally referred to as ESOPs. It is a right, it is a choice, but never an obligation. The beauty of ESOP is that because it is an option, it is never an obligation. These rights are given to the personnel to buy shares or get benefit in future. So a company gives a right to the employee to buy shares at today's price or maybe whatever discounted price in future, maybe 2 years down the line, 3 years or 5 years down the line, but it is never a compulsion. So if the share price today is 100 rupees and the company gives a right to the employee to buy the shares at 100 rupees after say 3 years, when the share price could be 400 or 500. So there is no compulsion. So employee can have a good night's sleep. If you can compare that with the equity investor who is required to put money in the market and takes equity risk. So there is no equity risk here. So he's getting an absolute right, absolutely no obligation. So if the price is 400, after 3 years, employee will buy. If the price is not much more, if prices for whatever reason goes below the exercise price, employee never exercises that right, never clicks that right. And ESOP derives the value, as I stated briefly, that the underlying asset is generally an equity share. So equity share, as all of us know, what an equity share is, that is the smallest unit of ownership in the company. So an ESOP is linked with an equity share. So if an equity share's value grows up, that means that if the company valuation goes up, the value of an ESOP also grows up. And if goes down, also it is going down. So that's why that is the DNA of ESOP, is that these are given to employees to bring in the convergence of interest of employees with that of the investors. So now, what does an ESOP offer? ESOPs offer reward for contribution, reward for retention. If the employee is likely to get retained with the company. So if the value increases, so he would be expecting a good value out of ESOPs. ESOPs also offer ownership. So normally speaking, this ownership concept is kind of, I cannot say new, but it is still evolving in India and it is gaining quite momentum. And employees are given the opportunity to co-own the company, or that is called the co-ownership, so that they can act like a shareholder, they can own like a shareholder. So that opportunity is also being given. So they are not looked merely as an employee, just a worker. And most importantly, ESOPs offer potential windfall gains, unlike cash bonus. For example, if for the forthcoming Diwali, company announces a 2 lakh rupees of cash bonus, obviously, whatever happens, the employee can expect to get only 2 lakhs. But if the company announces 2 lakh worth of ESOPs, on the occasion of this Diwali, and which can be encashed, say, after 1 year or 2 years, there can be windfall as well. That 1 lakh rupees can become 2 lakhs or 3 lakhs. So we have practically seen that in few companies. One of the companies, Power Finance Corporation, where their cash bonus is converted optionally. I mean, there was an option given, take 100 rupees or take 100 rupees worth of equity. So, I mean, there was a divided practice, and half of the people got 100 rupees cash and other persons got one equity equivalent to 100 rupees. And after 1 year, I'm talking about 2014-15, after 1 year, the person who has got 100 rupees might have deposited with bank and might have earned 8% prevailing at that time interest. But I'm talking about the ESOP holders, their share price has become 250. So that is the power. Windfall is there. That is the magic. So broadly speaking, how this ESOP help in wealth creation is that there is a community of employees. They contribute by way of getting retained with the company by giving a performance or corporate performance instilled into the system. Thereby, the corporate growth is ensured. With the corporate growth, we know that there is a value creation. And whatever is the value creation, at least the incremental part is shared with the employees. So this is all about how ESOPs work, and necessarily it works as a kind of cycle, water cycle, you can say. There is a steam that becomes water, water becomes rain, land absorbs that, again evaporation happens. So it keeps on happening. So in the ESOP ecosystem, as we know that an equity plan, it is known as equity plan, or an ESOP plan requires equity shares. So an ESOP plan necessarily travels through the shareholders. So shareholders must approve an ESOP plan in case it contemplates equity shares or issue of equity shares. So if you see the ecosystem, ESOP ecosystem, there are broadly 4 key players or key stakeholders, I can say. One is the set of shareholders, investors who are the owners of the business, who generally approve the ESOP plan, after which ESOP plan is really implemented. Another key stakeholder in the ESOP ecosystem is the management. So management is the community, I can say, with whom the day-to-day running of the company is entrusted by the shareholders. They are the caretakers of the business. They are interested with achieving the business plan and running the business fund on day-to-day basis. Employees are another key stakeholder. They are the backbone of any company. They work and they help achieve the targets. And regulator is a kind of ringmaster who regulates the entire ecosystem. Particularly, I'm talking about regulator means the legal or regulatory regulation I'm talking about. So now from the shareholder's point of view, a shareholder would like to say, because in any case, an ESOP plan requires equity shares to be used. So the shareholders would like to say that make an ESOP structure in such a way that it should use lesser equity, but should give much more benefit to the employees. Opposite should not be done. They generally disapprove if a structure contemplates heavy equity utilization and lesser benefit resulting to the employees. They also ensure that they often tell their management or to the ESOP consultant that ensure that because we are parting away with our equity shares for the benefit of employees, we must get it. We must get it good by way of appropriate corporate growth. And that corporate growth should not be on a momentary basis, but that should be on a sustained basis. And they are really interested in creating long-term value. They don't see the share price or they don't see the growth on day-to-day basis. Their real focus is on long-term. So they always focus on making an ESOP structure that would be creating long-term value for them. On the other hand, management, so we know CXOs I'm talking about, right from CEO, CHRO, CFO, Chief Compliance Officer. So CHROs aren't very challenging task nowadays, or sometimes it becomes how to retain people, how to motivate people. The company's competitors are giving ESOPs. So what kind of ESOP they should make so that people will stay? Otherwise, people come for interview, even taking up employment, and they soon leave. So obviously, CHRO is taking the brunt of shareholders that he or she is not doing the job. Similar is the case as a CFO. If I'm talking about an ESOP plan, CFO takes care from the point of view that the ESOP plan must not be inefficient from the accounting cost point of view, from the tax point of view, and a CFO may raise questions that how he can leverage the ESOP plan for rationalizing cash salary or rationalizing cash payouts so that cash can be conserved. So from the compliance point of view, there are few questions like the ESOP plan must be designed in such a way that there must be ease of administration. There must not be complexity coming into the system. There must not be any opportunity to the regulator to ask questions that your scheme is not transparent, your scheme is not compliance friendly, so on and so forth. But at the end of the day, the management has to face the shareholders. So they are also equally interested. The ESOP scheme must achieve the objectives. Now, employee point of view, employees will say, yes, we are ready to contribute, but give us higher benefit and don't impose on us heavy terms. So make it relaxed terms on us and make the plan realistic, predictable. Don't make the ESOP plan looking like a builder buyer agreement, so that employees must have a faith in that. So these are the employee expectations. Regulator, on the other hand, says that if you are making an ESOP plan, make it in such a way that transparency must be reflecting, that must advance the compliance and disclosure requirements. So broadly speaking, if you see, I mean, there are these many stakeholders. Sometimes their expectations are mutually conflicting, but that is not so. So the tricky part in making an ESOP plan is to find out a mid ground where it can be found that this is the point, this is the structure that seems very much enriching for all the stakeholders. So that's where the structuring is freezed. Now coming to when we talk about ESOPs, I'd like to tell you for your information and benefit that ESOP is a very narrow term in today's world or today's India. If we see SEBI as a regulator for listed companies, SEBI has a regulation named share-based employee benefits regulation. So share-based employee benefit regulation means SEBI is talking about any kind of equity-based compensation. So ESOP is a part of equity-based compensation. So it is one of the variants. So broadly, because ESOP is a very popular term, so we use often ESOPs, but ESOP is a kind of narrower term. So the broad terminology used is equity-based compensation or share-based employee benefits. ESOP is a part of it. Now, if you have equity-based compensation plan, by whatever name you call it, you can have two broad structures, because at the end of the day, you are contemplating giving benefits to your employees under the equity-based compensation plan, or you call it ESOP plan. So the benefit takes the form of equity. So in the equity settled, there are two broad mechanism of settlement. Equity settled means the benefit is delivered by way of equity shares crediting to the demat account. And another way of giving benefit to the employee is by way of giving cash equivalent of benefit by crediting the cash or money to the bank account of the employee. Now, so there can be a structure, there can be, I mean, you can have an ESOP plan which may contemplate only equity settled, it may contemplate only cash settled, or it may contemplate both. That is also possible. You can have a hybrid also, but that is possible for unlisted companies. So now if we go to see what are there in the equity settled ESOPs or equity settled equity based compensation plans, broadly around say 4 terms we have used. ESOP, employees. So let me read out here. ESOPs, SARs and ESOPs, ESPS. ESOPs or RSU in short, it is called restricted stock units. Even though Indian regulator never uses the word, but Indian companies used to use this word mainly. This terminology was imported during 1980s from US, Silicon Valley, when Infosys, etc., started their operation in India. So since then, this RSU word has been used, but it is an ESOP only. ESOPs at the face value is called RSU with some restrictions. So ESOPs is a right where the employee buys the shares at a future date at a predetermined price. So everything is determined beforehand, say today, but employee acts in next 2 years or 3 years or 5 years, depending on the different terms and conditions. So we will in detail discuss the stages. Another type of ESOP, I can say, or another type of equity-based compensation would be the stock appreciation rights scheme, where employees receive the shares equal to increase in the value of specified number of shares. I mean, for example, I'd like to give an example that under an ESOP, if your share price, the fair market value of share is 100, and suppose the fair market value of share would be 150 next year, and if you wish to pass on say 50 rupees to your employee, you will grant one ESOP, telling the employee that next year you give 100 rupees to the company will give you a share worth 150, because by that time the fair market value of share would have become 150. So employee would be getting 50 rupees. What the employee will do? Employee will pay 100 and employee will get an equity worth 150. And thereby he would be making 50 rupees gross profit. Now in stock appreciation right, what happens? One stock appreciation right is given when the market price is 100 today. And next year, the benefit will be given under the stock appreciation right. Company will allot half equity, one third equity, because 50 rupees will be the appreciation. Because next year the fair market value would be 150, less today's price is 100. So 50 rupees increment shall be given by way of equity. That means equity price at that time would be 150. So for 3 SARs, company will be allotting to the employee free of cost, without taking any money, one whole equity share. So for 1 SAR, it is 1/3 of equity, or 3 SAR, complete 1 equity will be given. So here, more payment is required from the employee, so that employee will get a whole 1 equity. Here, the stock appreciation right, the employee is not required to pay anything, but getting the similar benefit or similar quantum of benefit. Employee stock purchase scheme, whereas in the ESOP and SAR, I'd like to tell you that first of all, company issues a right or option. Later on, after 1 year, minimum 1 year, the option gets converted into equity. So under the ESOP and SAR, an employee never becomes an equity owner on day 1. So as on date of grant of ESOP, an employee never becomes an owner of the equity. But in employee stock purchase scheme, employees receive the shares upfront because they are required to pay a price generally below the market price. These are generally granted at a discount, and they become the equity owner on day 1. But generally this happens with a discount. So these are all equity where the employee would be getting the benefit by way of a credit to the demat account. Now talking about cash settled equity-based compensation plans. The same thing happens, but the benefit is actually translated or computed in terms of cash, and cash is delivered to the employees, to their bank account. The same thing that happens. Now, the another question is that you must have, most of you must have come across with or must have heard about ESOP trust or implementing ESOPs through trust route. There are some myths also. Some persons say that a company cannot implement ESOPs without a trust route. Let us bust all the myths and let us go into when trust route is required, when trust is not required. So broadly speaking, there are two routes available. One is direct route. That direct route means there is no middleman between company and employee. Company will implement the plan. That means grant the options. The things will go on, and employee will apply for shares, and company will directly issue the shares. This is called direct route. No middleman involved. Another route that is called the trust route. So the law has allowed only one middleman, that is the trust. No other person can play in between, a role in between the company and employee except the trust. So so these are the two choices, one can say, direct route and trust route. Trust route means trust is acting as a middleman or as a kind of platform. So the position of trust is that you can visualize first company, then trust, then employees. So trust acts as a platform for holding the shares and helps in ESOP administration, helps in share transaction. Now, the loss is that when, I mean, because there are two things, I mean, whether direct route or trust route, two things. One is source of shares. In case you are implementing an ESOP plan, you must get some shares. Now, the question is, you know that there are two types of shares. One is primary share, another is the secondary shares. So in case you are contemplating primary share means those shares issued by the company fresh, as and when required. That is called primary shares. So primary shares generally dilute, because if you issue primary shares, fresh shares, it dilutes all the existing shareholders. Whereas the second type of share, that is called the secondary shares, if you buy from the market, if you buy from any other shareholder, those are called secondary shares. So in case you are using primary shares, you have a choice. You can go either with direct route or trust route at your option. So you can you can just check the structure, which way should be good for you. But in any case, you have the leeway. Mandatory, it becomes mandatory. The trust route becomes mandatory when secondary shares are contemplated. So you may question me that why secondary shares are used. So there are many cases, like say Vedanta Limited is a prominent company in India into mine operations and minerals, etc., and metals. They have their ESOP scheme totally sourced from the secondary acquisition. So they acquired the shares from the stock exchange, from the open market, and then use under the ESOP scheme. So you can question me why. There could be some answers, and main answers to this is that some promoters feel that they have diluted enough. So they have nothing to dilute further by issuing primary shares, even though they love ESOPs. So they say that we like ESOPs, so implement ESOPs, but use companies' funds to buy the shares from the market and use that for ESOP purpose. So secondary shares never dilute the equity holders. Another main reason is this secondary. Another reason could be that say you have a company and once upon a time you are fair valued at 100 rupees. Company is also reasonably doing good. The market price would be 100, but for whatever reason your shares are dumped in the market at 20 rupees. So as a promoter, you would like that your shares must be taken from the market and could be used for employee benefit. Why 100 rupees shares if available at 20 rupees or 30 rupees? Why the company would be issuing still primary shares for ESOP purpose? So in that case also, some companies think that why not to use secondary shares because the shares are available cheap. Let us grab that, use that for our own purpose. Now, so these are the reasons I stated. Now, a case when a trust route is desirable, even though it is not mandatory. So if you use primary shares, typically what happens is that primary share issue, you know that for a unlisted or listed company, the process is long. It takes a minimum turnaround time for allotment. You call a board meeting, you call a share allotment committee, you inform to NSDL, CDSL. In case you are listed company, you also list those shares. So there is a cost involved, and that cost is repeated. Now, if your employees are repeatedly exercising, in case this is a primary, you are using primary shares, so it is best to have a trust, park the shares in advance. Now, as and when employees, a large number of employees will be coming to you for exercise, your trust window will just make a transfer. So which may take typically say 7 to 10 days. Whereas in case of primary direct route, using primary shares direct route without trust route, the turnaround time could be around say 30 to 40 days. And this is a uh, big impact in case yours is a listed company and your company share price is too much volatile. So anything can happen when the employee applies for shares today, and after 40 days, the shares will be delivered to the demand. The price may fluctuate to any direction. So from that point of view, for a quick transfer to employees, trust is adopted, even in case of primary shares. For unlisted, closely held companies, some companies don't feel comfortable. Imagine a company, a small company, may not be small or big, but imagine a company unlisted but closely held. So you are granting to say 50 or 100 odd employees. Now everyone would be getting few shares and everyone become a member, a shareholder. So in your company's register of members, you are required to write their names, and they may leave after getting the shares. So they may be selling to persons here and there. They may be untraceable. So some companies feel very challenging to track employees. So with a view to curb the physical movement, with a view to keep the capital table clean, short and clean, generally form a trust and give the legal ownership of the shares to the trust while giving the beneficial ownership with the employees. So employees don't lose a penny out of this structure. So this structure also works, but for unlisted companies. Another big challenge is that whenever you implement an ESOP plan or a big ESOP plan, even though your employees are sitting on crores of benefit, but they need to pay some exercise price. So from where they would arrange that exercise price of maybe say 20 lakhs, after which they will be getting a crore worth of ESOPs. The question is from where they will arrange 20 lakh rupees. If I'm talking about a very senior person, say the ESOP benefit is say 8 crore rupees, but he has to arrange 2 crore rupees as exercise price. So cashless exercise works magically in that. So in case there is a trust route, the trust uses some shares or sells some shares, very few shares in advance to garner the exercise price and taxation amount, so that employees can get the rest of the shares or cash benefit without paying any money. So that gives, this is a very good concept going on in India. So this is generally implemented through trust route. This is called cashless exercise. Very beneficial for the employees. Now, stages of ESOPs, there are typically 4 stages. If I talk about unlisted company or a listed company, any company, 4 stages are there. For the first stage is called what is called the grant. You can find these 3 wordings, grant, vest, exercise, in the relevant ESOP rules, regulations as well. So as per the regulation, as per the practice and practicality going on in the market, these are the stages. So grant is when the company issues the grant letter, employee receives the right. Obviously, terms and conditions are predefined in the grant letter. Nothing is left for what is called afterthought. कि बाद में change कर देंगे उसको. Generally, in the grant letter, everything is written, and the grant letter is given with the ESOP plan made as an annexure to it, so that the employee is aware of all the terms and conditions beforehand. And the next stage is called vesting. So there is a time gap between grant and vesting. That is called the vesting period. So under law, the minimum vesting period is 1 year. So you cannot think that as a company, say you are a owner or you are the CXO of a company and you are implementing an ESOP plan. So you should not imagine granting ESOPs today and vesting tomorrow, because the first vesting that can happen is after 1 year. The minimum vesting period is 1 year. You can extend that to 2-3 years, so the vesting can be staggered as well. If you're granting 100 options, you can have a vesting pattern like uniform vesting happening over 4 years. That means out of 100 options granted, 25 options to vest each year. Or 3-year uniform, you can have 1/3 of options vesting, say around 33, and 34 would be vesting. You can have different vesting period and schedules also, like you can have 0, 0, 0, 100. You can have, say, what is called front-ended vesting as well. So out of 100 options over a 3-year period, you can make a 50, 30, 20. Also, you can have this kind of vesting schedule also. But in any case, the vesting happens after a vesting period, at least of 1 year minimum. And during, as on date of vesting, from a CA point of view, from the accounting professional point of view, it is important to note that vesting is the stage that makes this provisional right into an absolute right. So crystallization of whatever accounting provisioning you might have made here, that becomes, you have to charge it, you have to amortize it. So vesting is on each respective dates of vesting, you amortize the ESOP cost, which you recognize at the time of grant. So if the vesting period runs over 3 years, so you amortize the total accounting cost over 3-year period. Exercise is the stage where only vested options after vesting, that means only vested options. In case there may be a question, sir, if no vesting happens out of 100, say 10 options would not vest. Obviously, those will lapse. Those will not qualify for exercise. So exercise means conversion of vested options into equity shares, or in case it is a cash plan, conversion into cash benefit. Only vested ESOPs. So typically what happens, employee pays the exercise price and perpetuity tax also. So we'll discuss the incidence of perpetuity tax. Employee pays this money and gets the equity shares. There is a TDS responsibility with the company as well, because employee is required to pay perpetuity tax, or company is required to deduct the perpetuity tax. So it is required to be deposited with the government by the company. So company takes care of the TDS part. So taxation things happen. The first level of taxation happens at the time of exercise. Now, exercise is not the monetization. Really speaking, exercise means you are getting the shares, the employee is getting the shares. It is ultimately this stage sell of ESOP shares and the employee gets the money. So whatever required shares are sold at this stage, and people get money. So talking about, say, Paytm, talking about, say, Flipkart monetization, you might have heard about how their employees got money, created wealth. It is the last stage sell, when after selling the shares, maybe to investors, maybe in the open market like Paytm. So in a Flipkart, they sold to Walmart, they got the money. But in Paytm, Zomato kind of cases, they sold in the open market and got the money. But it is the sell that is the what is called giving an exit. So grant is the entry point and sell is the exit point for the employees with money. Now, decision making, more or less we had discussed about the decision making part while we were discussing about the ESOP ecosystem the relevant key stakeholders in an ESOP ecosystem, like shareholders, investors, management, employee, regulator, etc. But typically, whenever as an inside or outside expert for a company, these kind of questions may come to you that a company is making ESOPs. So how should the company have the approach? So for the grant, while I mean, because we discussed that ESOPs have 4 stages. So accordingly, whenever anybody is making an ESOP structure, these 4 stages requirements are thought. Like in the grant, whom to grant? You have say 1,000 employees, so you have to pick and choose. It is never a practice. Very seldom. I mean, seldom companies grant to 100% employees, but most of the companies don't grant to 100% because their equity requirement would be too huge. So using little bit of equity, getting maximum output of that. So you need to have a filter to whom to grant. So to VP and above, to senior manager and above, like that, or to middle manager and above. This is a question that must be dealt with very carefully. The second thing companies used to check is that how much to grant. So whatever you are granting, that must not be inadequate or over adequate as well. So in Asnir Grover's context, he never believes giving over adequate ESOPs. He says that obviously, I mean, that is a logical thing to say so, that if you give over adequate ESOPs, employees will leave. Once they liquidate, they will just open the shops in front of the company. In case it is inadequate, then also they will leave. They will feel that company is totally worthless. I mean, there is no need to work here. When to grant and frequency of grant. So there is a plan from accounting point of view also. When to grant may have an impact on the accounting cost recognition. If you are granting, say, every 6 months, if you are granting every year, if you are granting once in 4 years, these are the all practices in the market. But whenever you are working for your company or for any client, you can see what is best for you. Vesting, what will be the ideal vesting period? In certain cases, it ranges, I mean, it is 2 years, it is 3 years, 7 years even. But the ideal vesting period is 4 years, but you can see what is best for you. Vesting schedule means whether uniform, like as I stated you, 4 years, uniform vesting schedule means 25% each year. Or if it is back-ended, then 10% in the first year, 20% second year, 30% third year, 40% fourth year. That is called back-ended. Opposite is also possible. So you can see what is good for you. So in case your company is required on a fair basis to achieve something, you can have a front-ended vesting as well, even though that is unusual. We have done this in certain companies, and companies say that our coming 2 years are very vital for our very survival. So if you are granting 100 options, make 50% options to vest in the first year, then 25, then 12.5, then 12.5. Because so it has actually linkage with the business plan as well, with your business milestone, with your core objectives of ESOPs. So accordingly, you can tweak this. Vesting condition has similar, linkages with your business plan. Accordingly, you can incorporate that. Ideal exercise period, it could be 2 years after the vesting, 3 years after the vesting, 4 years after the vesting. So accordingly, an exercise period is chosen. I'm getting some message. Exercise price is vital. So law has given you freedom while choosing exercise period. It says that you can choose any period, you can choose any exercise price, but under the law, in case you are using primary shares, the exercise price cannot be below the face value as per section 54 of the Companies Act. Otherwise, there could be other resistances as well, like say an investor in your company has got into your company at 1,000 rupees per equity. Now, if you are bringing an ESOP plan, you cannot say that the exercise price per ESOP for an employee will be 100 rupees. The investor is likely to resist that idea. So generally resistances come. In case you make 1,000 employees may register, they will say, then what kind of discount you are giving to us? Don't think that we are investors. But these need to be, as I stated you in the earlier slide, these seem to be conflicting, but actually there is no conflict. It needs a middle ground to be carved out. Certain special rights are also written, like tag along, drag along. You might have seen, if you have opportunity of seeing the shareholders agreement in an unlisted company, some of the clauses are taken from the shareholders agreement and put in unlisted companies ESOP plan. It is not applicable for the listed companies. So sometimes it is written that when you can exercise the shares, when you can get the shares. And for the sale of shares also similar terms and conditions are checked with reference to your company's facts and figures and business plan, that what shall be good for you. So typically, I mean, what happens is that you must have an ESOP pool. You have to define an ESOP pool percentage. Like say you are going to use 4% of the company, of the equity base, or 3% of the equity base, or 7% of the equity base. You have to write beforehand in the ESOP plan whether the shares shall be primary or secondary or both. These three things are possible. You can do that depending on your situation, your requirement. Obviously, I mean, primary, secondaries are done. Next question is whether you will go for direct route or trust route. This must also be decided beforehand. You have a narrow coverage or wider coverage. And from a accounting professional point of view, finance professional point of view, it is quite important to know, and generally these are estimated beforehand. What is the impact the company is taking onto itself? What is the P&L capacity for accounting cost? Whether the accounting cost on account of ESOP is completely wiping out whatever PAT you are earning or whatever PBT you have, or entire EBITDA is totally washed out, or what percentage of accounting cost that has in relation to your EBITDA or PBT. If that gives comfort, as a finance head, you can give your green signal that yes, you agree. In case it is a cash plan, cash settled plan, obviously, I mean, from the cash budgeting point of view, you have to see that whether the plan should be approved or not, what kind of cash commitment you are giving to the employees. So from the balance sheet point of view, do you have enough reserve? Do you have enough? I mean, what will happen to your book value in case everything is emptied, everything is gone out? So these are the pointers while doing an ESOP structuring. And the success obviously lies in forcing all the things. Generally, simulation is done. And the best simulation that can be done is by a finance professional. So that may give an opportunity for the persons like you to have a prominent role in ESOP structuring. Now, regulatory snapshot. We discussed almost about the aspects, the various aspects, even though time is short, even though it may not be possible to cover everything in detail, but mostly we have covered the key things. Now, regulatory snapshot, we can see what are the primary laws, rules, regulations for introducing an ESOP plan. I'm talking about private companies, unlisted public companies, and listed companies. Three types of companies we have. So the primary regulation is section 62 1B of the Companies Act, where you can find a mention that a company by of ESOP can issue fresh shares. That gives the mandate to a company. So for both these companies, section 62 1B is a kind of say starting point under which rule 12 has been framed, which gives a detailed rules for a detailed set of rules for how to implement ESOPs, particularly for unlisted companies, private and unlisted public companies. And there is another rule in case you have a trust, because trust is a blank entity, new entity. You create the entity. Obviously, that doesn't have any money. So for set it, for setting it into operation, you have to feed some money into it. So that needs funding. So funding is governed under Rule 16. Now coming to listed companies, the parallel of Rule 12 is the SBEV regulation. We call it SBEV regulation for listed companies. This is a kind of a constitution for listed companies on ESOPs, SAR, ESPS schemes, and other two types of schemes are mentioned. Those are not very prominently implemented, so we have captured only first three. And again, Rule 16, even though these rules are generally known to apply for unlisted company, but SEBI has stated that this Rule 16 will apply to listed as well. So you have to comply with this, where there are ceilings to what extent you can, as a company, you can fund to your ESOP trust to help you in the ESOP process. There is a ceiling, and there is a requirement to get a special resolution like that. But eventually, if you are, you know, helping a company, you are into a banking company or insurance company, you have to be convergent with the compensation guidelines. So the primary rule regulation would not be sufficient. Besides that, or in addition to that, what needs to be known is the sectoral guidelines. In India, there are two only, so there is no reason to fear that if there are other sectoral guidelines also. So broadly, two regulators, RBI and IRDI, had given additional guidelines for ESOPs, particularly for their top-notch employees. It is not relevant for every employee in banking company or insurance company. It is only relevant for their handful of top-notch employee, I can say, or I can say KMPs, directors, CEOs, etc. Accounting, that this may be of a very great importance to you, very great liking and interest to you. Like every grant of ESOPs, or I'm talking about any variants like SAR also, has an accounting cost impact. Every grant has an impact. Accounting cost is determined basis fair value or intrinsic value. So in today's India, if you see, because most of the companies, except very few exceptional cases like say banking and insurance, most companies adopt on a mandatory basis Ind AS. So you have to do the accounting cost basis the fair value of options, popularly known as Black-Scholes value, Monte Carlo valuation. Black-Scholes is the mostly adopted one. Intrinsic value you can still adopt under the guidance note 2020, particularly for those companies on whom index is yet not applicable. And value or cost of options is amortized over the vesting period, as we discussed earlier. And now coming for the FEMA, because India has relations with other countries as well. So I'm talking about cross-border grants. So an Indian company granting ESOPs to the non-resident, or a foreign company granting ESOPs to an Indian resident. In both the cases, FEMA will come into picture. So this first rule talks about in case an Indian company is granting ESOP to a person resident in other country, a foreign national. And the second situation is that an Indian employee is getting ESOPs of a foreign company. That means Indian employee is making a overseas investment. The first one, both are opposite, but both are covering the cross-border transactions. However, I'd like to give you comfort that for normal ESOP plans, genuine ESOP plans made up of good faith, there are enough exemptions, there are enough privileges, and the process for ESOPs are very simple. So there is no complexity involved in this. I'm talking about FEMA. And this is the case with other countries as well. Like the US, like other civilized countries, ESOPs have been given very liberalized treatment. That is the case with India as well. But few things we need to comply with. Talking about say taxation comes at last. So in our ESOP, there could be three persons involved, as you know, as we discussed. Company is the first person because the company implements the ESOPs, company issues the equity shares. So what is the impact or the taxation impact on the company? So as you know that grant of ESOP has accounting cost impact, and that is amortized at the time of vesting of options. So whatever accounting cost you have amortized is allowed as a tax deduction. Number one. Number two, this tax deduction can go up to the perquisite value earned by the employee upon exercise, because you know that the things will never stop at the time at the time of vesting, but the ESOP story will continue to run unless those ESOPs are exercised and sold as well. So your company can or any company implementing ESOPs can have a second level of tax claim that will be up to the purchased value earned by the employees, because employees will earn the purchased tax when they will exercise. So first level at the time of exercise, and second level one can check at the time of exercise as well. But in a nutshell, the total corporate tax cannot be more than what the employee has earned by way of perquisite or perquisite value and offered tax thereon. That is the total corporate tax limitation. And that works as a reconciliation as well. As far as employee tax is concerned, it is taxed at two levels, or two taxable events, I can say, upon exercise. So there is no tax at the time of grant. There is no tax at the time of vesting. So these are absolutely tax-free. Whatever number of options a company may grant to its employees, maybe crores of options may be granted at whatever terms and conditions granted. No tax at the time of grant and vesting. Upon exercise, so tax is on fair market value of shares as on date of exercise, less exercise price. This is taxed as if it is a part of salary at the salary tax rate. Now, exercise has happened. Shares have come to the demat account of the employees. So maybe next day, maybe next year, maybe 10 years after, the employee will one day sell those shares. So as and when employee will sell the shares, tax 2 will apply. That is called the capital gain tax. And the formula is sales value less fair market value of shares as on date of exercise. So this is linked. So up to this fair market value of shares as on date of exercise, tax has been cleared by the employee. So this becomes the cost of acquisition under the head capital gains. So sales value less fair market value of shares as on date of exercise, that is called the capital gain tax. And accordingly, this can be STCG or LTCG, depending on the period of holding and depending on whether the status of the shares is on date of sales, whether listed or unlisted. And in case of resident and non-resident foreign employees, tax on exercise is generally exempt in India, so there is no worry. But one must take care that the foreign employee may sell the shares. Of course, I mean, when the shares are sold, it is always deemed that the sale happened in India. Capital gain taxes are generally applicable. Whosoever is that person, and whichever country it is, generally it is applicable. Most of the tax duties provide that capital gains will be applicable, and accordingly, tax will be paid only after that the balance money can be remitted back. As far as ESOP trust is concerned, many persons used to have doubt whether this trust can have exemptions. This is not a charitable trust. Let us be very clear that ESOP trust nature is a private trust. It is a trust created by the company for the benefit of its own employees. So it is taxed as an association of persons. You can call it a body of individuals also. And it is subject to the same tax slab and generally taxed at whatever normal tax slabs we have. But practically speaking, I'd like to tell you that business, the head business profession will not apply to ESOP trust, because you know that ESOP trust is not supposed to do any business. It has a limited objective of helping the company in implementing the ESOPs. So practically speaking, ESOP trusts are generally liable to tax either under capital gains or dividend tax. Because capital gain is that trust will be getting the assets at 100 rupees and holding it for maybe couple of months or years and transferring those shares maybe at 150 or whatever price to the employees. So whatever gain will be there or eventual gains are there, those are subject to capital gain. And another thing is that while holding the shares, company may declare a dividend. So if the dividend is more than the threshold, that would also be getting taxed. Now coming to, I will just quickly finish in 2-3 minutes so that we can be open for any questions. Relevance for a CA in employment and practice. So during my practice, I have seen CAs having very prominent role in ESOP structuring and every aspect, wherever it is possible, every aspect of ESOPs. So one of the prominent, I mean, these are the prominent areas where CA in employment or practice can have a role. In employment, shall have also a role. Why I'm assuming so is that if a consultant gives you a report, so internal persons used to vet that, used to vouch for the correctness. So from that point of view, the fair valuation of ESOP, I'm talking about the block and soul valuation of ESOPs. The second point could be that accounting and disclosure. So talking about a person in practice, these services can be given or internal person can vouch for the correctness also. Accounting disclosure of the ESOP trust. So trust is separate entities also. They require different accounting, keeping books of account. Their disclosure of operations in the company's director's report, annual reports. Taxes on ESOPs. I'm talking about taxation of everybody in the ESOP ecosystem. Taxation of the company, taxation of employees, taxation of ESOP trust. So broadly speaking, taxation of ESOPs. FEMA certifications for remitting the money outside India, Form 15, CACB, these kind of certifications are done. Advisory validation of ESOP structuring, helping in overall decision making as an expert. Deepika ji, I think I have covered. I would be happy to answer any questions.
Thank you, Acharya ji. I will just look forward for the questions if there are any in the chat box. Give me a moment. There's a question from Chennai from Sujata Padmanabham. She's asking, what happens if employee leaves the company before exercise the option but vested?
Yes, typically. So, Sujata, I'd like to answer this. I mean, if you apply this answer to any type of companies, whether listed or unlisted, both the SEBI ESOP regulation and the MCA ESOP rule both say that vested options cannot be simply forfeited. That means company has to give a window for exercise. Now you have to settle either for by way of suitable writing or suitable provision in your ESOP plan that in case any person leaves with vested options, that you have to give a window for exercise.
भैया आप लग जाओ, मम्मी नहीं है. हाँ, रख के चले जाओ. Yeah.
So I'm telling that vested options cannot be simply forfeited. You have to give a window for exercise. And in case you are an unlisted company, typically some unlisted companies don't give window for exercise, but they keep a provision for settlement of those vested options. Otherwise, I mean, talking about certain companies, like say, I'm talking about a company who doesn't have money as well, or they feel that that person has worked well, they generally allow also to exercise as and when any liquidity event will happen in the company. I'm talking about a startup. And this is going on quite as a trending, it is happening that in case of resignations, they don't allow to exercise, they don't give cash, but they allow to carry those options, vested options with them, as and when any good event will happen, or say IPO will happen, or a strategic sale will happen. They allow that ex-employee to encash their vested options during that time. But I'll as a nutshell, I will say that vested options cannot be simply forfeited as a rule.
Thank you, Acharya ji. I hope the problem has been resolved, Sujata ji. So, as the round has been completed, I would thank you, Acharya ji, for your valuable time to us, and looking forward to more valuable sessions at the webinars at CP Committee. I, CA Deepika Agrawal, conclude the session. Thank you all.
Thank you. Thank you, Deepika.
Thank you.
Thank you, everybody.